Hello, everyone. Welcome back to Trend Following Trading Club on Spaces every Friday, 8 a.m. Eastern Time. We have an international audience resisting being too East Coast U.S. centric. So it's very difficult for us Americans, as you know. But anyways, another fun week, another good week in the markets. Well, try to ignore P&L. Just the market weeks are fun usually. It's fun to watch the world unfold and see that you can't predict it, and following trends is still a pretty good idea. So I don't have a lot on my agenda today. I can't think of too many interesting topics. I tweeted a lot this week, but mostly about the wonderful trend following and replication. I'm obsessed with replication, of course. Uh, Congratulations to Andrew and his fund going over 1 billion, firm going over 2 billion. Pretty sweet, pretty nice idea. Started the year at 60 million, and now it's over 1 billion. He posts his positions every day, and I look at them every day, and it's pretty fascinating to watch how he can replicate the SocGen CTA index with 15 positions. They raised $25 million yesterday, because it also shows the AUM per day as well. So, anyways, um, it's easy to find. Just go out to the DBI Managed Futures ETF website. You'll see the link. So, Oleg, how was your week?
Hi everyone. Hi Jerry. Hi Richard. Hi Brian. Hi all the guys. My week, because I have found Top Traders and Blocked a systematic investor podcast in 2019. Every week is happy week because I trust the algorithm. I trust trend follow. I trusted it before, but I trust it now 100%. What I do, I have confidence in this. So my week is always great. And I remind myself when I begin to think that week is not very good, I remind myself it's great. And this week is really good in terms of performance. Orange juice is good performance, for example. Not bad. I want to say that in different circumstances, in different cities, in different relationships with some people, I know that I have main things for me, and one of the main thing is this trend following trading club discussions, and really I saying the same thing, that I'm always happy because of it, and it's from the bottom of my heart I say this. Thank you.
Oh, yeah, you bring up orange juice. My friend Mike posted a picture of two pictures. One was of orange, because I was making a comment that you can't discount these smaller markets. And, there was an article I posted where people were doing that, just saying all the moves occur and have occurred in the large markets. Not true. For some of us who let profits run, it's been very important to catch those outliers in some of the smaller commodities. Um, so he posted this picture to bolster my point, which orange juice is one. I've been long. I never got shaken out. Loose pants kept me in the whole time. And then the second one, I had no idea what this was. It looked like maple syrup coming out of a tree. And I asked him, what is this second picture? And he goes, it's rubber. I'm like, oh, I didn't even know. I don't know. I don't know what rubber is. I don't know where it comes from. I'm short. So that's good. But, oh, yeah, someone else was commenting this morning about all the things that we kind of expected to work in this inflationary environment kind of hasn't worked. Tips, gold, Bitcoin, bonds. Well, not bonds, but and I thought, Yeah, tips. I think I read about tips, Treasury inflation protected securities. And yet I put the tip ETF in my portfolio a while back, anticipating that I was going to short it. And I wasn't even paying attention that in its name, it says don't short me during inflation. And I shorted it anyways. So it's kind of funny that I recommend not paying attention to, and so often in this day and age, um, the name of something, especially if it has anything to do with politics, is the opposite of what the name should be. So, anyways, can't pay attention to the name of instruments any longer.
I want to say that it's a very great idea not to pay attention on many things in our life, daily routine, because we must have the main things to pay attention and not try maybe to predict the future because of the our we are scary, people scary, and they want to predict the future, and it gives them false safety, sense of safety. This prediction the future, but it's not the right way, and people pay attention to very different talking heads, very different ideas, very different articles, but it's nothing. It's only when we do so, it's only probability that 50-50. So it's no sense in this. It's better to pay attention to your discipline, to be focused, to pay attention on the algorithms, and a lot of things we must not pay attention. I'm absolutely sure.
Good morning, Richard.
Good morning, Jerry. Good morning, Oleg. Good morning, everyone. I must admit, I listened to the Andrew Beer podcast with Niels. Look, I was listening because I wanted to unpack how you do this replication, and to be honest with you, I didn't get much further into the technique, and I'm hoping someone here in the audience or whatever might be able to sort of provide ideas. Obviously, clearly he's replicating the SocGen CTA index, not the trend index, but the CTA index, by taking the dominant trades. I don't know how he's doing that, but does anyone have any ideas how that's being done?
Yeah, hi everybody. Hi Jerry. Hi Richard. Yeah, I listened to Andrew Beer's podcast interview about the replication, and I have to say, I was all throughout the interview and at the end, I was left with a weird gut feeling that there's something was not, something wasn't right, and I couldn't put my finger on it. I have a technical background, and the what he is doing, from the way I understand it, the mathematical problem is the following. So there's 19 time series, 19 return streams that he observes over the last 20 days, he says. So the look back is only 20 days. So there's 19 points, so 19 by 20 daily return matrix. And all those are summed into one index. So they create one index. And the mathematical goal is, given these 19 return streams over 20 days, he then chooses 10 or 15 other return streams. Let's say 10. I don't know, Jerry said 15, but I thought he said there were 10. There may be 15, I don't know. And he just picks 10, I don't know, twos, fives, tens, some energies, some whatever from each sector. And the goal is to find a vector. So the mathematical goal is to find the one-dimensional 15-member vector. The vector is length of 15, which is the number of his markets. and to put a weight on each of them, to put a position on them. So the mathematical question is that how to pick these 15 numbers when multiplied by the 15 return streams of his chosen markets will replicate the closest the sum of the 19 return streams of the funds that he is targeting. So this is a well-known mathematical problem. This is linear. This is just linear approximation.
I thought it was sort of like an exercise in correlation mapping. That's what I was sort of grabbing out of it. What do you think?
I wouldn't even go that far. It's not that complicated. I mean, this is very, how shall I say? This is very rudimentary. This is linear matrix algebra. It is linear. It can be done heuristically. You can do it with a search. You can least squares approximation or whatever. So basically, the question is which 15 numbers, which when you multiply with the 15 return streams, 20-day return streams of his markets that he's having, approximates the closest the sum of the 19 20-day returns of those funds. And this is a linear mathematical problem. And then there is a solution. There are some closed form solutions, there are exhaustive search solutions, and whatever. So the mathematics is nothing new. And this could have been done in the 70s, in the 80s. You can do it by hand. You don't even need Excel spreadsheets. You don't need powerful computers to do stuff like this. And
so what he's effectively relying on is his choice of his markets versus what he's replicating.
Yeah.
He's looking at the mathematical summation that approximates what he's mapping effectively.
Yeah. So basically, I mean, I can put it this way: you don't even have to know any math. Like if you have any computer skills, so search the universe of all possible 15 number vectors, like 15 like a vector meaning just a series of 15 numbers that you can multiply your 10 markets and their 20-day returns, and then do that summation, and how closely that summation over 20 days approximates the 20-day return of the sum of the 19 funds that he's tracking. And then try another one, You can use genetic optimization. There's closed form solutions. There's least squares approximations. I mean, a long time ago, I've written an article in Encyclopedia on least squares and approximations. And so this is nothing. So you can do this with pretty much anything, with any 19 return streams. You can say, or 100. You can say, for example, I take the 100 highest capitalized tech stocks in Nasdaq over the last 20 days, and my goal is to replicate those 100 with these 5 tech stocks. And I want to find which 5 positions of these 5 stocks over the last 20 days, which 5 positions fixed now over the last 20 days, would have approximated the return of the 100 tech stocks in or whatever. So you're basically compressing, you're approximating your space. He has one universe and one performance, 19 funds over 20 days. He tries to replicate it with 10 instruments over the same 20 days and looks the same. And then he says, okay, today this is that vector that approximates this series the closest.
That's fantastic. Absolute. That makes a lot of sense. So he's benchmarking to this group of CTAs that he's monitoring. So exactly. he's not achieving absolute returns. He's simply achieving a benchmark result against the thing he's mapping to.
Absolutely. So the question that he's asking the computer is which positions in these 10 markets approximates these 19 funds the closest. And that's the position that he adjusts to. So when that changes, and he does it. So how I see this, we're very careful about overfitting, about selection bias and everything. I think there's a lot of exposure to a lot of the things that all of us are very aware of. Overfitting, selection bias. So I think, for example, there are many ways in which this thing can so to speak, stop working. And by stop working, meaning the tracking may not become as close as promised to investors or whatever. The beautiful thing about this year is that the moves have been so clean and so that's why all trend followers have good performance, and why it's so easy, and why we're so giddy, and why everybody is like happy and whatever. So I think part of he's riding on the coattails of the goodness of trend following this year, which kind of separates, the Warren Buffett says, yeah, when the tide goes away, then you see who's swimming naked. So when the tide is high, everybody looks the same. Everybody's doing the same. Everybody is happy. Everybody's is profiting. But when the tide goes down, when performances start to diversify between trend followers, and some are doing well, some which we have had over a long time, I think what will start to happen with this ETF is that first, as the performance starts to diverge, maybe from the index, he'll try to choose different markets, because even in the interview he mentioned, something happened, this and that, this moved, and then we went back to analysis and whether should we add this market into our 10 markets or subtract this one or replace crude with, I don't know, something else. So there's a lot of decision making here, which to me, from my gut feeling, looks like people, young backtesters still not aware of all the pitfalls, and you can fall with overfitting, with selection bias, with what you do and how you adjust and how you just pick and choose things and parameters or instruments or markets. And so I don't know. I mean, the success is overwhelming, but I think the success is more a reflection of just nothing else working in this market. Stocks, bonds are down. There's a lot of money that is getting out of stocks and bonds and being completely, their rugs being pulled from under their feet, and they're just looking for anything that's green this year. And that's pretty much the only thing that's green this year. And when trillions of dollars try to sniff out something green, that's how you go from 60 million to 1 billion. So that's my opinion. But we'll see.
And I think,
Yeah, that's really interesting.
I think having an ETF really helps raising money as well. And he's very good at telling stories. I listened to another podcast yesterday more than once, and he just continually tells these stories about Seth Klarman. It's usually this, and a lot of his experience, and he's not a managed futures person, which means he kind of is a managed futures person. He's very good at all of that. And he also admits, I know I don't know if I can't remember if it was with Niels, but on one yesterday, he said that it's much easier to replicate a group of managers. So we've all bought into CTA returns can be approximated by looking at this SocGen index. And so we bought into that, and he's saying, okay, cool, then I'm going to give you what CTAs are doing. And he admits it would be difficult, and even tells Niels, I don't think it would be correct to try to replicate a single manager. And he says it wouldn't be cool for someone to try to replicate me, like the one day later DBMF fund. And then I proposed, and Niels asked him this question. Jerry thinks it's harder to replicate a CTA who truly lets profits run and does make money from orange juice. Andrew is famous for saying no CTA or hedge fund ever says, I made a lot of money from pork bellies. Well, pork bellies don't exist anymore, but I think what he's trying to say is these smaller markets, these outlier trades, and that's what trend following and managed futures doesn't do any longer, is it doesn't allow one or two markets, whether they're small or not, to have this incredible outlier with this incredible profit, incredible volatility. They rein it back in. So he says to Niels, I don't have the gilt. I'm sorry. Well, he doesn't have the gilt, and he doesn't have the British pound. He just has the yen and the euro. And it doesn't matter because that group of CTAs is reining in that British pound and reducing the position because the vol kicks up so much that he can approximate um, the currency as a sector and by just with the euro and the yen because it is a big sector move. And when any one individual market gets out of line, i.e., has too much profit or has too much volatility, that group of CTAs, they reduce the position. So I think it's very interesting that he is beating them at their own game. And the smartest people in the entire industry with the most assets under management also have the most complex ways of trading. And ironically, I think it's easier for him to replicate those guys versus me. He would literally have to trade hundreds of markets and guess which ones I'm trading because I am going to let those profits run. I am going to make money on orange juice and some stock he may never have even heard of.
Yeah, I think that I think he's going to find it difficult if he wanted to replicate trend. But the CTAs, I'm assuming what he's doing in his universe that he's using for his replication, he's got to assume there's enough cross-asset exposure in there so that he can replicate anything that the CTAs are doing. He's not necessarily doing it with the same markets, but his mapping process is producing the same correlated result effectively. So he must, in his universe, have sufficient wide diversification to basically represent any of the regimes that CTAs in general have met over a historical time frame.
Yeah, I also was wondering, and I wanted to ask him a question. He must have done this, otherwise I wouldn't have launched a fund like this without doing this. This must have been back tested in the sense, okay, how do I know that this works? So fine, he's tracking the index nicely or even better this year. Tracking it better would really surprise me, by the way. I don't think it's all from fees.
I'd say the weak edge is sufficient, that the fees are enough to materially produce a better result than the thing he's tracking.
Okay, so but my question is, I don't know, Richard, but this, if I was launching this and I have the math and I know how to find this 15 number vector from any 20-day series of 19 funds, I would go back 30 years and then try to pick 19 funds that have lasted 30 years, at least if this SocGen index hasn't lasted that long. But at least I'll try to find 19 funds that existed 30 years and run my backtest. So go through past, go through history, pick 10 markets that have lasted 30 years, that have existed, and create, look back 20 days, create position, create P&L, create P&Ls, and then create my equity curve and compare it with the equity curve of the 19 funds and see how closely my equity curve is tracking this pseudo index equity curve over the last 30 years.
I think he said that in his conversation with Niels. They do extensive back testing over multiple decades for their scenario. So I assume he's doing what you're saying.
Yes. So, but if that's the case, again, we come back to the same problem of curve fitting and selection bias. So, what if these 10 markets closely approximate these 19 funds, some 19 funds over the 30 years, but other 10 markets, if you replace 3 of those with markets with some other 3 markets, then it doesn't track them close enough. So basically what you're saying, out of the universe of 100 futures markets, I need to choose 10 that closely approximates this universe for the last 30 years. Well, that may have been for the last 30 years. So my point is, at this point in time, you have the last 30 years of these 19 markets. But you don't have this luxury for the next 10 years. So 10 years from now, you'll have another 30-year look back window for which other 10 markets would have approximated the best. But you don't know
you've got to be prepared to change the universe.
You don't know what those 10 markets will be ahead of time.
I'm assuming he's got the flexibility to adjust his universe if he can't get the mapping right.
Okay, well, but that's the thing. So that's the same as saying you assume you have the flexibility to adjust your parameters of your model to changing conditions in the markets. So we're coming to the problem of overfitting.
Yeah, he must. Hi everyone. He must help his models somehow. He cannot trust only on brute mathematical brute force to find what's the weights of his portfolio. I've tried to replicate the positions of hedge funds based on major market indexes, not exactly to trade them, but to get a glimpse of what people are trading. You guys know I come from an economic from an economics background, so my part of my job is to understand where the industry is, how trades are going, and I can tell from experience that yes, you can easily approximate what the industry is trading through simple models, nothing more linear regression. The thing is, depending on the window you're looking, the back your back window, you don't get as nimble, or you don't get how fast people are changing positions. And the way Andrew changed his positions and tracked the index so closely suggests to me that he is not doing just a model to try to brute force identify what the CTA's positions are. I suspect he also has some equations that define how these funds change their positions. One way I think might tackle this problem, this question, is through passing a Kalman filter through his data. So the way Absolute describe the problem is exactly how I think too. You think of the return of a portfolio as the weighted average of different return streams. So all you have the return streams. All you have to do is find these weights. The thing is, these weights also change over time. So you have to have a model that copes with this change. If you have some kind of rules that describe how these positions change, then you're good. And the fact that these large CTAs take trades during days, they do take some time to change their positions. So it makes Andrew's life easier this way. But yeah, that's it.
I remember Andreas Klenau in his book Diversified Trend Trading. He devoted about 3 chapters to replicating the different trend following programs through his understanding of their universe, and there was a couple of factors he was using to replicate, and he was getting very close replications of their historic performance returns. That was a really good read in that section of the book. It makes me think that, whilst we think there is a lot of sort of secret sauce in what we're doing, I half suspect that it is a lot weaker than what we think it is. And I think that, if you are trading a correlated ensemble, it's not that difficult to replicate.
Oh no, I don't agree with that, Richard. I think what we do is much more robust, because imagine you're completely naive to the trend following philosophy. You don't cut your losses and you don't let profits run. You simply look at a return stream and try to replicate it. At some time, perhaps things are going south really hard, and our cut your losses rule will protect us from wiping out all our capital. If you're simply replicating and you have to wait until the week passes, or your look back window passes for you to run your equations and find out what people did, perhaps you're dead before you even know it. I don't think that is as robust as having simple rules driving your portfolio. I really don't think so.
But wouldn't that show as a major um, divergence from the tracking, as a major tracking error or in a 30-year backtest? Because trend followers have gone through, you know, drawdowns like that, as you described, many times over the last 30 years. So each time that has happened and his algorithm has failed to capture that and has diverged from tracking it, it would show in the backtest, no?
Yeah, in the backtest, yeah, but I'm not as confident as the as I'm not as confident to trust these backtests on a future possible on a possible future that has not happened on the backtest. I don't know.
That's true. So this goes along with the same thing that I described. So
Yeah, exactly.
so basically it may have, what you described may have happened with 20 other universes of 10 markets, right? But then he picked the one universe of 10 markets for which that hasn't shown yet in the backtest. So this universe of 10 markets that he has picked has survived the divergence from performance in some way, some random way or whatever. But there could be tons and tons of other universes of 10 markets for which if you backtest these weakness, this delay in reaction and cutting losses would be obvious, and then the divergence would be great, and then he would just exclude them, he would just dump them. I don't like these 10 markets, they don't track the universe so well as opposed to these 10 markets that now I picked. I think there is some danger to this. So
Yeah,
the only way to test this is, as Richard says, is with actual real trading going forward. And the big test will be when this performance, when after this peak and new equity highs in trend followers, we get to the next 30-40% drawdown, we'll to see how these 10 markets and how their reactivity to cutting losses will actually be good in tracking the performance.
I think it's baked into the cake that because of the way this group of CTAs trades, as I've stated earlier, that he's okay with this group of markets. And if he survived the COVID, February, March COVID 2020, then that's a good indication. So I think it's just the delay. Some people posted on Twitter that they had suffered because instead of selling the breakout, for instance, they noticed that performance would be a little bit better if they waited a week or two. It didn't seem to matter. Maybe it made it a little bit better, and that's just bad idea, right? So then they got crushed during COVID. So I think it's this delay is more. If it's 110 markets, the delay is going to be problematic because that's a perfect period where it was so crucial. Performance was so different if you had any sort of a delay or a longer term system versus a shorter term breakout.
When you have when you try to identify the position on 110 markets, the life of your model, it gets extremely harder because most of the time a lot of these return streams are going to look really similar, really similar, and your mathematical model is simply incapable of telling which one which market do you have on your which market the one you're trying to replicate have on its portfolio. Take for example Brent and WTI. From someone completely naive of the trend following philosophy, he will look at your performance and say, okay, perhaps you have WTI, perhaps you have Brent, I don't know, perhaps a mixture of those two. I really can't tell which one you have. under the roof, you running your trend following model know that you have, I don't know, equal allocation because the ATR is similar, and that's fine. But someone looking from the outside perhaps have one or have another. And suppose at some time things get completely uncorrelated, and one of these goes through the roof and the other crashes down. Your model isn't capable of beforehand telling which one you have. So he tried to make the model's life easier by restricting what markets the model will look at. Okay, so most of the time Brent and WTI move similarly. So I will discretionarily I will remove Brent from the universe of possibilities and have my model trading only WTI. But that's the choice that Absolute was warning us about. Perhaps in the future, WTI will crash and wipe out your model. We don't know beforehand. That's the risk
Yeah, but
that
what I
this
was
I
kind
think
of
I think
strategy
the
runs.
markets. Hey guys, just quickly,
Sorry,
and
I'm done.
great to be back. I think the markets that he's using, it's 14 markets, by the way, not 10. It's pretty heavy on US bonds and rates, but I think these markets are sufficient for him to deliver against his objective. His objective is to track the SG CTA index and not a single trend following program. He's not looking to track Jerry. He's not looking to track me. And I think he'd have a very hard time actually doing that. But tracking the ensemble of these very large CTAs in the index is actually something that he can do with these markets, because the index constituents of the CTA index, they're all like, most of them, I guess, are $1 billion funds. It's Alpha Simplex, it's Aspect, it's Ford, poor Ford, Man, is Transtrend, Winton. They're all in there, so I think he can do it with these markets. The and I agree with Jerry and everyone that he's a great explainer, a great great on podcasts and fun to listen to, because he sometimes gives things a valuable different perspective. The my key point is what we all do is we want to cut our losers and reduce the risk if a position goes against us. It hits the stop, we get out. And the way he trades, or the way the replication work, I think that is actually an open risk for him, is that he could face a runaway market and he doesn't get out of the market, and he actually runs a larger loss than any of us would, especially in a gap type of environment, because he's updating his regression. I'm not sure if he does it daily or if it's kind of like once a week. I think it's actually once a week. So he's looking at the regression, he lets it run on a week. What if there's a couple of markets that go completely against him? Like, he's short everything in his portfolio except for crude oil right now. He's short every interest rate, fine. He's short gold, he's short the S&P, short emerging markets, short yen, short euro. What if, all of a sudden there's this, we've seen it in the UK now with the gilt markets, all of a sudden there's like this super fast reversal that hurts him. It goes the other way. With his regression, he's not going to kind of like sniff that out immediately. It may take him more than a week, even maybe 2 or 3 weeks before he's actually flipping things around. And by that time, it's not about getting the new position right. It's about cutting the loss, which I think Niels unfortunately hasn't asked him about that. That would have been my question. It's kind of like, how does he think about keeping losers small, which is so important to what it is that we do, that we're so agnostic about these individual trades. If they start losing money, we just kick them out and we don't cry about them. We just do the next 1,000 trades. The way his system, it is a system at the end of the day, works. It's not built for that. It could really be, there could be a scenario where he's really getting hurt, I think.
I agree, Moritz. This was beautifully explained. And so it's not the delay in the ETF. It's not just because of the weekly adjustments and not daily adjustments. The delay of the adjustment is the 20-day look back period in which the change in positions has to have enough of points of entry, right? So let's say the 19 funds change their position significantly, and over the first week. So the next adjustment is next week, next Monday for the ETF. But even on that Monday, there may only be 3 or 4 days out of 20 in which the funds are now reflecting change of positions. But those 3 days out of 20 are not enough for the ETF to change the positions, because there's still 17 days of the previous old positions. So let's say in the 17 days, all 19 funds are short rates. And then I'm just hyperbolically saying now they switched, all of a sudden the change was so big that now they switched to small longs, even flat or small longs. So on the first Monday, when the adjustment is made, when he does the regression, there will still be 17 days of short rates returns, and only 3 days the adjustment in rates will not be there. He still will be short 2s, 5s, and 10s. Then he'll have to wait another week. So another 5 trading days. So now we're 7, 8, 9 trading days away from the bottom. In the next week, the big funds are now slowly getting long. They're 20% long, 30% long, 40% long. He's still short. He's still minus 80% short. So there's almost 2 weeks of difference in performance, which by the second Monday, then he sees, oh, now the 20 days return strings, now 15 of those 20 days are flat to short and only 5 days are long. And the regression kind of starts to get confused. And now he's like, okay, now we don't know where we are. So 5 days are short, 15 days are long. We kind of need to be flattish. So he slowly then starts to cover and kind of become flat, whereas all the other funds are long. So the way, as Richard said, so the only test is just going forward, because we don't know what we don't know. We don't know in what ways these 10 markets with a delay of adjustment are good at replicating the universe that they're targeting to replicate. That's why I'm assuming the backtest was done and rigorously done without overfitting and without selection bias to guarantee this. But it remains to be seen. The judgment should not be this year, because this year, since launch, everything has gone in one direction, and everything has been a single trade, which he has been riding. So there's not a lot of mixed signals in the 20-day streams for his model to get confused. So we'll see.
Did we find out whether he's actually using an underlying trend following model with his universe, or is it just position application?
Yeah, just position. I don't think he's using any models. He was actually saying there are ETFs that are using models, but they're inferior. They don't have a lot of assets. Nobody likes them. In the interview, he was kind of poo-pooing such attempts of replication. So I think he's definitely not doing that.
No, he's not using models. That's right. We know this from his podcast, because he says the dispersion is going to be too great, right? If he had like 100-day breakout model and 150-day and another moving average model, he says like all these CTAs trading these different models, they're too different from one another, and he just wants to be average. He just wants to be the index. He just wants to track the index. So he's not, which is why he's not using these models. You could say that, okay, he could be running thousands of different types of models. I'm not sure if that would get him close to the CTA index from SocGen. I probably prefer that type of trading, because when you run the model, be the cheapest on the model, offer your model at the cheaper price, but have a stop loss, control your risk. Don't run the risk of letting any of these markets hurt you too much. That is what keeps you alive. I think the markets which he trades, like, we've never have seen these gap events yet. It could be in the future, because we haven't seen them in the last 30, 40 years doesn't mean that we're not going to see them going forward. But like the US bond markets, I mean, it's never been gappy really there, like to the extent that that could kill you. All of the markets that he has in the portfolio, they're relatively steady, but he's not trading the Swiss franc. The Swiss franc in 2015, maybe he would have been on the right side of that trade. I don't know, but you have these instances where things go completely wild. Gas markets.
But it only matters if the underlying CTAs handle it better, different. He can get lucky. They can all reverse their positions. He's slow at reversing. They shouldn't have reversed. The market goes right back in a trend following way, and he profits from it. I mean, it really is just how he interacts. And are they taking small losses? Are they caught with these losses? How did they do in the Swiss franc? And so it's one of the funny things is one of our friends, Arthur Sepp, a month or two ago, he put up a chart of how DBMF had done versus the SocGen trend index, and it had beaten the SocGen trend index by a few 100 basis points or 100 basis points. And then someone reminded Arthur that they're not even targeting the SocGen trend. They're targeting the SocGen CTA. So they're beating indexes that they don't even target. It's just very humorous.
That's so funny. I agree with you. He could be lucky on these reversals, right? It's just
now Niels asked him a good question that he didn't answer. Niels let him off the hook, and then I tweeted the same question, and he didn't answer me either. And that is, he does seem to. I see this as kind of a fatal flaw, or too much slippage. Tracking error flaw that can easily be corrected, of course, and that is, I believe, I'm pretty sure. I couldn't say for 100%. I listened to the podcast more than once, but it seems to me that these 15 markets are fixed. So there's not going to be a 16th market necessarily, and he talks about his UCITS product, which at some point they have that as well, and it doesn't trade crude, for instance. So their attempt to replicate a crude position a while back was to short treasuries. And he says, oh, yeah, that didn't work. And I don't think in the current group of markets he has any grains. And so I wonder why. Why not follow 65 markets, the core liquid markets, and then have the algorithm choose the 15 or the 12 or the 10 or the 22. Why just 15 and force the model to choose from a large position to a small position in all of these fixed markets that he has? I don't get. I would think that you would want to have corn and soybeans that are perfectly liquid as an option. And if you don't need them, like you probably don't need them now, but that I didn't really understand, because there is going to be a time where all these CTAs are along the grains, and it's going to matter even with their fall and correlation adjustments.
I half suspect, Jerry, it starts getting incredibly complex the more you include. The number of permutations you've got to do in your weightings, I think, probably uses incredible computer power. So it might be that he's had to reduce it to that level for simple sort of PC crunching and the ability to achieve what he's doing with his regressions. But I do know as soon as you start, lifting the universe, the permutations just get out of hand.
Yeah, at some point, the correlation of the assets enters your calculation of the weights. If you put in assets that are too much correlated, it gets incredibly difficult to tell them apart. So he chooses only gold and not gold, platinum, and silver and palladium, for example, because you choose one you choose one asset to represent that class. That's it.
Yeah, well, Jerry, Richard, the answer to that question, I don't think it's the limitation is computer power. Computer power is cheap these days. The answer to that question is, again, this is the gut feeling, which I'm trying to put a finger on the gut feeling that I don't have a definite answer, but something makes me uncomfortable about this, and it's here I would say. So let's say your algorithm was you have 65 markets in which every week before you rebalance, you have to choose which 15 will best represent the 20-day returns of the 19 funds. Now, this problem becomes so complex in the parameter space, in the choices, in the if-then universe, that you can make it like in your fund, in your strategy, for example, you can say, oh, but why do I have to use breakouts? Why do I have to use moving averages? Why don't I just have all the choices in front of me? Everything that I know that can potentially make money, mean reversion, trend following, breakouts, this time frame, that time frame. And every Monday, every week, you ask yourself, oh, which one of these things would have performed the best over the last 20 days? So that's the equivalent of so if you expand your universe of possibilities, the search problem is not the computing power problem. The search problem is the problem of overfitting. The search problem is that, yes, you will find something that fits, that answers your question the best for the last 20 days that you're trying to fit. But that exponentially lowers your robustness. And
Well,
you just
I think it's two different things. Like we're certainly not doing the same thing because I'm guessing about the future and I'm basing it upon 30 or 40 years worth of data. And I want to trade as many markets and different time frames and trend and moving averages as I can. But it's all just a guesswork for the future. He's looking back over 20 days or ever how many days, and he's trying to come up with these weightings in these markets. It reminds me a bit of Excel Solver, which I have used a lot, not for trading, but for fantasy football or fantasy hockey, right? Trying to understand what, how many of these different elements, what is their weight, what should their weighting be to determine whether, how many points are going to be scored. And the problem with Solver is it comes back with a perfectly great answer and a percentage for each of these variables. However, there's probably more than one answer. And yeah, so I think that's his problem. There's more than one answer. He's nailed it over the last 20 days, but the future may not look like the last 20 days.
Yeah, exactly. And the more markets you include in the model, the more answers you'll have, the more possible answers you have. So he minimizes the number of markets to reduce the number of possible answers and make his model's life more easy.
And I think that it's maybe in terms of robustness, of course, like Jerry said, that the future will not look like. And I think sooner or later, I think it's 100% guaranteed that it will not look like past 20 days.
So,
And
hold on. So I wanted to comment on Bruno. So, see, I don't really understand because he's that idea because he sits there and he's like, oh, you know what, guys? I just ran our replication and it's really not that great today. We don't our 15 markets are not doing a good job of explaining it. And he's a smart guy. He mentions this on the podcast that he looks at the charts. He tries to understand what's going on in the world of CTAs apart from this replication. So he says, oh, okay, cool. Yeah, here's what's happening. Soybeans broke out. They're all long soybeans and corn. They made a lot of money this week. in soybeans and corn. There's no way we can replicate that with our predetermined 15 markets. Well, let's just throw what happens when you threw the corn and the soybeans in there? Oh, we match it perfectly. That's the question. It's pretty easy. And so step outside of the model, see what recently broke out, see where they're building up this position and what's profited. And so, but it sounds like he's has this idea of no soybeans, no corn. Like, why? Are they not liquid enough? Is he planning on, a $20 billion fund? And he cannot risk the possibility, and he can't get on enough soybeans and corn for a fund that's 10 or 20 billion. So I don't understand. It would be so easy, not complicated at all, to tell the computer, okay, here's 2 more markets or 3 more markets. How does that work? Oh, perfect.
But I think his problem, Jerry, is he doesn't want to overfit. So what he's doing is, I think he's only concentrating on the very large moves. I did notice in the podcast he said he wants to be exposed to the big moves. So he's not looking at copying something with exact fidelity. He's after the relationships that exist within his broad universe of markets that he believes sufficiently represents the universe that he is replicating, even though it's trading different markets. And he's after the principle that it's the big home runs or the big things that actually drive the market. The rest, to him, I would assume, is noise. So I don't think he does want to trade with fidelity, exactly replicating them to the sense that he is curve fitting or overfitting. I think his principle is sound. I think Absolute's onto something here, but I just need to think about it a bit more.
Well, he's definitely not trying to get the big moves the way that you and I discussed them. He's definitely doesn't have to. That group of CTAs is not participating in outlier moves in orange juice or the grains. They're reining those trades back in and making them more normal and more part of the sector performance. So when we talk about big trades, what he's trying to do is get the big money, and they're all loaded up on these positions that people have described before, short those currencies, short all these interest rates. And how did he do what did he do when those interest rates, for instance, broke out a year ago? It wasn't a big trade yet. So he can't wait for it to become a big trade. Now I'll get on it. No, he's guessing ahead of time accurately, because they are going to load up when these things hit the breakout and way before it becomes a big trade. And that's what he does as well. And I guess if soybeans and corn were as liquid or for some reason in his portfolio, and they loaded up on those in November of 2020, like I did, he would put those on as well, way before it became a big trade. So he can't risk not doing it, waiting for it to become a big trade. And I don't understand how choosing 15 markets accurately, good choice, he did a good job of those, is less curve fitting than adding 5 more to cover the grain sector. I don't understand.
I suspect he could. At some point, he must draw the line. It's just that your algebra problem gets much more complicated. You have to make more concessions, perhaps. I don't know.
It just convinces me that I probably won't get into the game of replication.
Richard, I just sent you an article from, as Absolute said, back in the 80s. People were researching this topic, this regression with time varying parameters. Perhaps there is some light in there.
Great.
Yeah, I mean, I'm very. I think it's fun to watch him cause havoc, but it's only fun because he's not messing with me, and so I'm not interested in replicating other people, but I am interested in not being replicated. And
I've got your word for it, Jerry, that he's not replicating us. I bloody hope he's not.
I love when you say Come and get me, Andrew.
Yeah, but I think it's kind of just a continuing of our big discussion of simple trend following that trades a lot of markets and that truly allows a small market, a large market, every market, any market to have a material impact on your portfolio. Like when I was in 21 or 20, when I made 15% on a small Tesla position, that's a material impact to my portfolio. Okay, you got to go find that and track all of my 150 stock positions and my 150 futures positions. And so, okay, simple trend following cannot be replicated, but the SocGen index can be so far. And regardless, much easier, strictly because of it's an index and how that group of CTAs trades. And if something major happens in a market, how quickly is not each individual CTA in that index, but how quickly is the group going to change from long to short? Slower, possibly, than you could imagine. And so he just has to keep up with this very slow moving group. Because as he says in his podcast, when the markets crash, some of these people are selling and the rest of them are buying. So I think his biggest problem in the future is that the index sucks. Oh, I'm great at replicating something that's not very good. That's what I would be worried about. He's hitched his wagon to an index. Oh, okay, Fort. Okay, 1 out of 20, so nothing to worry about there. I don't know. Wouldn't be so sure.
There are, as I was thinking of other problems going ahead for an ETF like this. If and when it becomes large enough, I mean, he's talking, so there's 50 billion, I don't know, 100 billion, whatever. So if
He's 2 billion now.
Yes,
Is he?
well, no, it's 1 billion for the fund, 2 billion for the firm, I think.
Thanks.
And so one problem I can see, and he probably shouldn't be as transparent as he is about what he's doing, is front running. So if it becomes very big and everybody can do the regression analysis over the weekend, I would know what he will be buying or selling next Monday, because I know how the positions in those 15 markets will change if I do the same regression analysis that he's doing. And if he becomes big, it may take him more than an hour or a day to actually make the adjustment if he gets to 10 or 20 billion. So front running becomes a problem. Second problem may become, if everybody knows, and if he becomes the largest player in the universe. So if everybody knows that these 15 markets are now being traded as a representative for the 19, I think the funds themselves, because they already know, so he's sniffing data from them, but they can also sniff data from him. So if they know that these 10 markets are actually what's being traded as a representative for interest rates or for commodities or whatever, so if they know what he has picked, they may deliberately lower the allocation to these markets to the extent that there's still liquidity in the others, and try to represent their positions in other interest rates markets. So now there could be arbitrage opportunities where the 2s, 5, 10s against the rest of the world interest rates start to act in a divergent and convergent manner, where then funds will show up to trade this convergence and divergence, depending on how far away 2s, 5, 10s have gone from representing the rest of the interest rates universe. And so chaotic micro universe will now start to create, like a game theory, where the players in this universe are trying to outgame each other. try to read their intentions, read what they're doing, and try to outgame each other. So, as I said, this is still early on, but if this becomes very big, I can see how it gets known, if to the whole world and to the funds themselves that are being replicated becomes known that there's a huge whale in the bathtub, moving markets around, trying to replicate them, they may try to outgame him.
But absolutely, isn't this the same problem that we as trend followers face when the big institutions try to guess the positions of the big CTAs and try to tell their clients what the critical prices are, and etc. etc. I mean, it's not that much of a problem for us, is it? I don't think it would be for him. And now I'm speaking on top of my mind. I didn't really thought about this, but the point you brought is really interesting, that the front running of DBMF could be a problem. But as it is a inherent divergent strategy, or trying to replicate divergent strategies, isn't that good for him? I mean, if he's trying to buy and people buy in front of him and price getting higher and higher, isn't it good?
Well, it's not good, because his entry price at which he enters now goes against him. Whereas he could have entered on Monday at a certain price and the trend continues. If it takes him 3 days to enter, as the rest of the world is front running him, then the market pushes the price. So his average entry price goes against him.
Oh,
And
yeah, that's right.
Same way on the other direction.
Yeah, you're right.
Hey, Alp, what's going on? What do you think about all this?
Hey, Jerry. Hey, everyone. I mean, this is a very interesting conversation, actually. I'm not very close to this, but I mean, and this week I was doing a lot of coding, so my mind is, I was just thinking about the implications of using machines and, what are the things that can be replicated. I mean, so far people are obviously not very positive here in this conversation, but maybe the hard truth is, yeah, I mean, he can replicate an average CTA index, and he can do it for a long time, and he can make a lot of money out of it. Hey, maybe it's an awakening new thought that we all just need to get used to in this new technological era. So that's maybe something else that we just need to accept in some shape or form. And of course, the next question is, what are the other things that can be replicated? If I take a step back from, trend following and market, can you replicate? I mean, I'm sitting in a coffee house at the moment. Is it possible to replicate a good coffee, a Brazilian coffee taste, for instance? Or can you replicate the secret formula of Coke? And can you replicate all this stuff and just get on with it? And maybe this is where the life is going. Maybe with this so much computing power, our life is just going to be significantly different as we move along, and a lot of the things that we get used to are just going to be replicated with safer options, and those safer options are just not going to be the things that we will accept first, but it will be much more regulatory friendly. It will be much more friendly to the human race. They are going to be much more less aggressive forms of anything else in business and in life in general. And the more we replicate it, the more we will have the opportunity to extend the life and just live a less volatile life, possibly. And it's just the more we incorporate the machines into our processes. I'm possibly diverged from the conversation a little bit, so apologies for that. But this is where my thoughts are today. Thank you.
Man, my question from the very beginning was, what's the next step? What are the CTAs going to do? Allow him to continue to do this? or what is their move going to be? Drop out of the index, don't show their return intra-month, and then what's his move going to be? So, or they're just going to, hey, live and let live. This is fun. Watch him raise billions off of us. At some point, I'll try to have Andrew on this Spaces so we can ask him these questions. Sorry, Richard, go ahead.
No, I was just saying that.
DBMF as a new market?
Look, one of the things I do is I do track the performance of funds, and I look at I try and cluster groups of trend following funds into how I perceive or view their style. So, when I look at say Mulvaney, I'll look at funds with say a 25-year, 22-year track record, just like Mulvaney. And then what I'll do is I'll look at their correlation and and I'll map them together. And what I find is that the correlation of maybe 5 of my index of say 55, 60 trend followers come out of a close correlation of say 80% for 5 of them that closely map what Mulvaney's doing. Then I put them together as an ensemble. Now, when I do that, I'm thinking in terms of, well, there's an 80% correlation of these 5, yet we do get, over the course of 30 years, a significant dispersion in the results of those 5 in that composite. But they are closely correlated. So, in regimes where they do well, they all do well. In regimes where they do poorly, they all stagnate and they all build up drawdowns. But they map as an ensemble quite closely together, but over the course of time, they do diverge. So then I'm thinking, from Andrew De Beer's perspective, I'm saying he's got this margin factor of the very low costs. So, all of these funds are playing with performance fees and management fees, and that does, over the course of 30 years, give a significant degree of dispersion. And when you reduce that dispersion, I would half suspect that you could mimic the returns of that ensemble of 5 through just through sort of a safety factor of the lower fees, provided you are doing something fairly similar to them. And the difference in those 5, when I look at it, they've got a different universe. They're trading different universes. They've got slight different sort of nuances with their systems, but there's sufficient similarity there because of this weak edge that they all have this fairly high correlation. So I think Alp's right. I tend to think that he's exploiting this fact that there isn't really, in the scheme of things, with a rules-based process and all of the rules that Jerry and I talk about, I think if you apply those standard rules, then the dispersion of those funds that apply those rules is not really significant in the long term. A lot of it might be due to random variation, but the overall dispersion, I think, is just a natural outcome of randomness, and I think that he's onto something.
I think that big CTAs, they trade the same markets because they're limited. Because if they have a big amount of money, it's a issue with liquidity, and so the biggest cities have the same markets, and so they will be, and also they have the same strategies. I'm talking now about a trend following funds that the same view, the same strategy, in fact, and of course it will be very correlated. It's at least my opinion here. I think so.
Jerry, I have a question. So you raised a great point. Is there a legal obligation that a fund must give their daily performance every day if they're not a member of an index?
Well, I don't think so. And I think that this is a requirement that SocGen put on the CTAs to be included in this index. And they happily said, sure, because this index they feel is going to help them raise money. It's an honor to be part of this index that is sort of acknowledged to be the index. There's others, bridge alternatives, of course,
But even so, even if that's the case, being a member of an index, they can just renegotiate with SocGen and say, hey, yeah, we will provide you our daily data to calculate the index, but you don't have to publish it to the world.
Funny, and what SocGen's saying, why aren't we getting something off of this? And maybe they are. Someone told me, I think yesterday, that they feel like that SocGen is charging a bit, and Andrew is paying a bit. I don't know if I got that right, but it's definitely possible, because they were telling me that there is a move afoot from the CME to charge funds for the closing prices that they use to value their portfolios, if when they use those valuations in the public domain. So people want, and the S&P, of course, if you ever mention S&P or S&P 500, you have to pay for that. So it's pretty funny how it's all shaking down, and it's all because he's just become so darn successful. And to some degree, when I hear him, and he mentioned this with Niels, it's like we need to get away from what is a trend, what is a breakout, and we need to talk about the markets. We need to put all of performance in terms of a story. And he's a very good speaker. He's very funny. He laughs a lot. He has a good laugh. And he tells these stories. Some of them are the same. And it's really refreshing. And I think he's also saying, hey, speak to your audience. What are they saying? I want an index. I want an ETF. It matters to people that the index is low price, 95 basis points. That's another thing. Some places it says 95, some places it says 85. He hasn't really cleared that up. And I understand Niels's point to some degree. Like, don't evaluate us based upon the fees that we charge. Evaluate us on our net returns after fees. Sure, however, human beings know that that's in the past. How can I tilt the odds in my favor of making money? Well, choose good CTAs, choose good managers, and then don't overpay. Now, if you have a ridiculous situation like Renaissance, overpay. But you want to start the game not too far behind. And, like I said in one of my tweets, Andrew was up 33% in the past few weeks. I tweeted that based upon that return, a 2 and 20 hedge fund would make the equivalent of 1,000 basis points. And a lot of those CTAs, that's what they charge, is 2 and 20. So in a world of ETFs, retail, normal people investing their own money, they've been conditioned to choose a 5 basis point S&P fund over a 9 basis point S&P fund. And when you show them a alternative at 95 basis points, that's the world they live in. And then you equate it to 2 and 20 equals to 1,000 basis points. That's laughable. They're all going to say, there's no evidence you can show me that I'll be better off paying 2 and 20, that I will agree to pay 2 and 20 when the 95 basis points is sitting there.
So, Jerry, are you suggesting that, and I'm not saying 220, but without the ETFs, without the 95 basis points, I think if the market is free, that's the price that the market is setting for anything. I mean, there's a reason why S&P 500 is 5 basis points, and there is a reason why Renaissance Medallion or whatever was 5% and of assets and 40% of profits. So if the market is free and you're free to pick where you want to invest, the market values the service you're receiving, whether it's net performance after fees or whatever. You don't need an ETF. See, the ETF would be a solution if it's a competitor to the CTAs, to the 19. Oh, there's a 20th now instrument that's providing similar stuff to the 19. Not only similar, but it's kind of aggregating them all, and it's doing it much cheaper than them. But it cannot do it without the 19. This situation is unsustainable.
Well, that's what that's what we have to wait and see. And CTAs, I wouldn't assume the CTAs are going to sit on their hands, nor would I assume when they make their move, SocGen makes its move, that Andrew's going to sit on his hands. I'm looking forward to this and observing this car wreck, this train wreck that I'm not a part of. And I agree with everything you said. And also, I agree that this is very normal, very American to upset the status quo and a low cost provider to come in and say, hey, let's target a market where we think we can deliver value, take market share, and deliver a good product for lower cost. And
Absolutely. I agree. I agree. Free markets. Free markets.
Market. Exactly. I'm just making the minor distinction between when Niels or anyone says, don't pay attention to the fees, pay attention to the net return. Well, that's a good thing to say, but there's a little bit more complexity wrapped around it and human nature wrapped around it, that the future returns are unknown. We will go into a drawdown. How did CTAs ever go into a drawdown after 2022? I thought they were immune. No, we're going to go into a drawdown. And then people are going to say, well, the only thing I know for sure is 95 basis points versus 2 and 20 for the future.
All the power to Andrew. I mean, this is admiring what he's doing. This is totally American spirit, totally free market. It's wonderful to watch and to observe and to see how it changes the game and how different actors in the space interact and take action. So it's going to be interesting to watch. I was just going to I didn't mean to be negative on him or on the fund. I was just trying to describe, or for myself even, speaking loudly, why did I have this kind of some weird gut feeling about the replication and how it needs to be tested in different environments and in different universes. And I'm still not convinced that whatever they're doing or whoever they have on their team or whatever is fully aware as to the dangers of the unknown unknowns. Like in what ways, what your strategies, because they do have a strategy, they do have a model. In what ways their model and their strategy could suffer from selection bias and overfitting. That's all.
I think that's a good warning. I have no problem with that at all. I think, there's no such thing as a strategy or a group that doesn't stumble. And, this is, since it's outside of my knowledge base, I need to not say anything other than what I've said, which is I enjoy watching this all play out.
I remember Meb Faber talking about how I think he had this program, which was a theoretical program called the Ivy program, which was using Warren Buffett's SEC filings to mimic what he was doing. And I'd be interested to know how that went. But I think Meb was saying that, despite the delays in the filings, there was sufficient return in the approach to just mimic what Warren Buffett was doing. And I think he got pretty good performance returns just by doing that through his theoretical sort of application of Warren Buffett's process.
Yeah, perhaps there are some rules under there that within their models that prevent them from running into huge losses. We haven't seen them. The recent period has been really good for CTAs in general. So yeah, I totally agree with Absolute and Jerry on that. It's really amazing what Andrew is doing. It's amazing his track record. It's undeniable. It's just that, yeah, I also have this feeling that something's missing here.
feeling in your waters.
And another thing I tried to bring up last week, I'm not sure if anybody agrees or has had time to think about it, but I think that this particular style, managed futures trend following, not one entry, one exit, and a stop loss, I feel like it is just, this is the type of markets that it's going to do very, very well. It's outperforming for numerous reasons. Um, maybe it does continue to reduce the positions based on vol and correlation, but it also increases positions. I think most of them true up the positions monthly based upon the new AUM, and the AUM profit, and keeps going up. The profit factor increases their positions, and another thing I came up with, just trying to think out of the box here, which I should have been thinking about years ago because it's way more than vol targeting. I graduated from vol targeting to 6 months ago, maybe something like I said vol and correlation management, because it's way more than just targeting vol. And then Niels called it dynamic rebalancing, I think. And then I think it's more like a dynamic portfolio and positions. And one thing that I advocate, I'm not, the person, not the source for classic trend following, but just the way that I was taught is a fixed universe and fixed unit sizes. So I trade the British pound the same size all the time, irrespective of my commitment in other markets. So sometimes I might only have on currencies, and my positions are very small because my portfolio is sized and unit sizes are created based upon what happens if I have every trade on. Well, I think that this type of strategy, probably the non classic trend following, probably has a risk budget to fill up. Um, and they can fill it up with way more currencies and interest rates this time, um, and not be restricted like me to a fixed allocation all the time for these markets in those sectors. So I just think that um, this is a brilliant time for this type of strategy. It's really outperforming, and Andrew is benefiting from that outperformance as well because he does outperform them so far based upon his fees, the fee differential. But once again, he did mention in the podcast I posted yesterday, I think it was yesterday, or maybe it was Neil's, he does say, like, we really had a problem with our usage once because we were not able to go long crude, and we tried to offset that with short treasuries, and it obviously did not work. But he laughed it off. Like, yeah, we lost 600 basis points of performance. That's the way life is. And I think that when you're going to gain, he's going to gain loyalty from ETF people who like low fees, and they're going to laugh it off too the next time he kind of underperforms, at least the first few times. And we'll see by how much he underperforms. But he's really come up with something brand new.
Jerry, you mentioned. I also think there is a difference in the clientele and the clients who are getting into the ETF versus actual investors who are direct clients to the CTAs and the trend followers. I think a big part of the edge in trend following is not the model itself, but the intellectual and philosophical education and understanding of the world that that allows you to withstand the drawdowns because you know the process, you know what's going on. And people who are getting into the ETFs, who are the 60-40 people that are all red now, they're looking for greens and whatever, I think on average are less educated about these things. So the test will become how many of them will stay in the ETF in the next inevitable drawdown in the CTA trend following universe. I think the clients who are with the funds themselves are better educated and they're paying the higher fees to actually keep them in the strategy. for the funds to actually educate them and philosophically prepare them for the process. So basically, they're paying the tuition and they're paying the stoicism and the courage to withstand the process. Whereas with the lower fees and just making it, retail level, people are trading this as any other ETF or as any other stock that's cool today, like Tesla or Facebook or whatever. And then when they go in, then they go out because it's not green anymore. Everything else is green. So what's the next green thing? That's another comment.
Yeah, I agree. I think we're all subject to hot money. I do think, though, that everybody's pronouncing 60-40 dead. Everybody is the memory is going to take a long time to go away of if you had CTAs or if you didn't have CTAs. But I do think some of these institutions and high net worth people and people who have not bought into replication yet, they're going to feel this pressure from their board of directors or their clients, in the sense that, why are we paying 2 and 20 or 1 and 20 when it's out there for 95 basis points? And I think this fee pressure could start to build. But one of the things that makes it so interesting is how easy it is to buy these ETFs. And I follow the 13F information for a lot of managers, including the people who hold DBMF. And you're starting to see some large organizations and institutions buy. And it's just too easy. I can buy. It's not a huge decision. Let's just put a few million in and then we can take it out later if it doesn't work out. So I think that you can't underestimate this, everything he's got going with the way he talks and the ETF version and the low fees. It's just like a perfect storm.
I wonder how, since it's difficult to get approved for an ETF. I mean, I guess it's not easy. I just look at how hard it is for a Bitcoin ETF to get funded, which is kind of ridiculous, I think. So for the regulators to approve an instrument, which is this ETF, that depends on data of 19 other funds to be given daily. For me, it's like, okay, well, what if they stop? So what happens to this instrument? Now, if this fund becomes 50 billion and all the 19 funds stop providing data, or they provide it with 5-day delay or whatever, what happens with the $50 billion fund?
Look, usually these things are already been squared up. If it becomes 50 billion, it's going to be too big to fail in some shape or form. So, the larger you get, the more you become part of the establishment. And these things
I agree. But how do you give? And by the way, I'm not for regulators at all. I wish there was no regulators at all. But to the extent that they exist, and then they stop and block more reasonable instruments from being publicized, they're allowing instruments like this with big unknowns, where they depend on a lot of unknowns.
What about Jerry Parker? I mean, Jerry, why you're not issuing a ETF version of your strategy? What is stopping you just to make a, Chesapeake ETF so people can invest into an ETF?
Well, I think I'm looking into it. I'm thinking about doing one. It's really a very easy question as to why or why not, and it is basically the break even of how much money do you need to manage and raise if you're charging an incentive fee versus if you go the ETF route and you only get a management fee. And then the management fee is sort of expected to be 100 basis points or better 99 or 95. So, you sit back and you sort of do this calculation. Yeah, well, maybe we can raise $1 billion in an ETF. That would be difficult. Andrew did it, but he said he's been around for 15 years. Or I could raise 200 million and charge 1 in 10, and it's kind of the equivalent. So that's really the spreadsheet answer is how it's much easier to raise in an ETF, but you're good. And plus, Andrew has to split his management fee with the advisor, and just knowing how it all works. We are registered, and Chesapeake does have a mutual fund, but we split the. We're not the advisor. We don't want to be the advisor. We're not equipped to be the advisor, and so you're inevitable in both an ETF and a mutual fund. You'd have to split a low fee. Oh, it's just horrible. But maybe you could raise more money. You don't really know. So maybe I will figure out a way to have an ETF product and have a private fund product that justifies high net worth people paying an incentive fee. So that's what I'm kind of working on in my head.
Yeah, but it would be a good way to market it. You can always say that, okay, so this is an ETF actually who does the real thing rather than replicate an average CTA. So there is going to be a definite appealing side of it, while the communication of it goes to the regulators and investors of those ETFs. And in this world, it seems that I'm looking into ARK, what ARK is doing now, this DDMF. So there's a lot of actually demand to this sort of product, and there is if the product is genuine rather than an average index, it's always I believe there is an additional appeal to it anyhow, and this is what I would have thought about it, and if not you, someone else will definitely going to do it. That's what I think about that. It's because it's you cannot if there's so much demand to an average product, someone else is going to come and say, okay, so this is the average, and I'm going to do the genuine one. So we trade X mini market. This is the ETF version. Let's see what happens, and maybe this is the way forward. Thank you.
I don't know. I talked to some ETF experts recently, and so it's really advisor experts, and they have models. These advisors around the country, and they have these models, and you need to be put into these models. So I felt like I needed to talk to someone who had experience in this field, and they said one of the most important things about an ETF is that it tracks an index. Oh man. Oh, that's right. Andrew tracks an index. Of course he does. So, it's more complicated. There's more to it. There's more details. It's outside of my world right now.
But not ARK, right? ARK is an ETF. No, there is an ARK ETF, right? Which is down by 70% or something.
True.
Raised billions.
Yeah, and she has something going for her that she has created a almost a following and a religious following that people buy the fund as it continues to go down. So I do think a Chesapeake pure trend following type strategy might have some traction in the same way that and of course with me it would be much different and a competitor to some of the funds that are out there that take a good chunk of the mutual fund money and own long stock indices all the time. I would have a material allocation to single stocks and trend follow the single stocks. And so my idea would be a product that absolutely doesn't exist right now, but it would be pure trend following. And I don't include equities just to include them or overweight them, but I feel like that there is a proper allocation to equities in a trend following portfolio based upon the amount of diversification you can get from looking at thousands of stocks. You probably want to can safely allocate a bit more to thousands of a universe of 1,000 stocks versus a universe of 40 currencies or 55 commodities.
Yes, and that sounds actually excellent idea. And when I look into those people, like the person who's running ARK, or Warren Buffett, or Andrew on this new replication ETF, as we've been discussing, there's a lot of things that happens on the communication end. They are great communicators. So people are staying with the ARK because they communicate the strategy so well and so easy to be able to understand anyone. So this conversation happening on the spaces is like ultra complex, very technical, very philosophical, you know, and in so many ways, this is a very snobbish conversation between, people who actually are trying to do it quite a different way, So I think the challenge that I would probably put in forth is to be able to become an iconoclast person, but the communication side of it is going to be hugely important when this sort of an ETF will go out, and when it needs to be communicated with people who doesn't have any idea how markets work, how trend following work, all these complicated stuff, or the ideas that are so natural to us are going to be so alien to them. I mean, you just need to think about that side of it. I think the communication side of it is going to be hugely important in the success of such a product. That would be my wild guess. Thanks.
Andrew's going to be very happy that we spent an hour and 45 minutes talking only about him. This is, I think, part of his strategy. Does anybody want to switch subjects and for our last few minutes?
Hey, Jerry. Can you hear me?
Yes.
Okay, thank you. Hey, thanks for doing the call. I'm a newer attendee and follower and of yours. And the question I have, and by the way, I'm 100% a believer in trend following. I clearly understand a lot of the concepts and so forth. I don't have the feasibility to be able to trade the way that a CTA or a private person or investor that can put all this together. So I am very interested in like the few ETFs that are offered out there, and I've done a pretty deep dive into the three primary ones that I'm looking at. At any rate, so the concept is, like if you go to an advisor, like with one of the big houses or an Edward Jones off the street, they're going to put you in a pie chart, the old 60-40 most likely, something along those lines. And so with trend following and using these ETFs, the question I have is, do you just throw the pie chart out the window, get away from the traditional, if you will, quote unquote, modern portfolio theory, traditional pie chart, and go all in on a trend following system? And if that's something that obviously that you do with your own portfolio, and in how many people have made their fortunes?
Yeah, that's a tough question because you're dealing with people, and you've got to get them to buy in and hold on to your diversified portfolio. And so everyone's a bit different or has different situations and tolerances. Obviously, for me, I don't think that there's I don't think you can improve upon a fully diversified, typical CTA trend following portfolio, and which, has a lot of different markets and has short trades and has the stop losses and the ability to change direction based on the trends. And I think that's just, I don't think that looking historically at asset allocation when the traditional markets that they talk about and long only, is a good necessarily way to think that that's the way the future is going to be. So I think that's the issue. Sometimes you need to be short, sometimes you need to be flat, and you need to change direction and have more markets. I put in a podcast. I tweeted a podcast yesterday of some guys saying like the best way to diversify your portfolio during inflation is long commodities, but long commodities all the time has a big drag. That's right. Everything's going to have a drag if you don't have a trend rule that gets you out of it when the trend reverses. And hopefully you can have a short rule where you can actually profit in these bonds. Like
Yeah.
bonds and gold are great as long as you're short.
Yeah. Yeah. I think that's good. And so I think, for me, I just thinking like, if you can stomach, and a lot of people have this year, if you can stomach a 20% drawdown in a 60-40 portfolio, you ought to be able to stomach a drawdown in a, trend following CTA style portfolio, whether that, that drawdown is 8, 10, 15, 20%. But when the trends catch, in the portfolio's position correctly, and by the way, I was going to ask, so, and is the volatility typically lower than in these trend following CTA style portfolios then because of all the diversification, or do you find that standard deviation or volatility actually is higher than say a 60-40, and knowing, we're in the outlier year with the 60-40 portfolio?
Yeah, I don't really know those numbers, but I think the volatility in the CTA products is pretty healthy and high sometimes.
Mm-hmm.
So I would expect, but I think this type of CTA product that he's replicating has a big dose of volatility control. And they try their best to, they're hitting the ball out of the park, but they will be very quick and nimble when the markets reverse and when the volatility goes higher to reduce those positions. However, if as they reduce, if the trends resume, they will get caught having reduced positions or changed direction a bit more unfortunately than what happens to me. And so it's just basically two different types of trend following.
Okay. Hey, one last question, and I might have missed it from earlier on, but you just mentioned replication. So am I to then understand or believe that like, say for example, you look at DBMF, that seems to be like one of the larger ones out there, and maybe older, I don't know. The replication. So are they actually running a separate like hedge fund somewhere that's only institutions and ultra high net worth have access to, and then they're piggybacking and doing trades at a later date to replicate that, or how does that work? And I'm sorry if I'm redundant from an earlier comment or conversation.
No, they don't trade another fund. They just replicate. They try to replicate the returns of a CTA index, SocGen CTA index.
Okay.
Yeah.
Okay, so they're managing to a benchmark that's made up of a whole bunch of other CTA portfolios, in essence, that are reporting.
That's right, and they charge 95 basis points for that, and most of those CTAs charge a management fee and an incentive fee.
Yeah. Okay, and so that's the DBMF. Now, what about? Let me so it is CTA, or there's another one like MTMF or something like KMT, something like that. Do those follow? I mean, they're all just trying to manage to a benchmark then, is that right?
I think they actually come up with their own rules. Maybe they created a benchmark with those rules, and then they try to make that same return by actually doing the trades in the ETF. So that's a bit different.
Okay. All right. Good. All right. So I guess, and I'm sorry if I keep pounding the table on this same question, but and I like the fact that you brought up 60-40 was like your grandfather's portfolio, kind of like, like the Buick was your grandfather's automobile sort of thing. And that maybe these CTAs and trend following are kind of like the future because, again, we have the technology, we have the ability to disclosure and the lower cost that this may be, if not in whole, it deserves a larger place at the table when it comes to putting together a portfolio. Is that fairly accurate in your mind?
I think so. I mean, every market possible can be included in the trend following portfolio because you're not relying upon how each one of these markets did on a buy and hold basis. If you throw trend following on top of these markets, they all are add to diversification and they make money. So I don't care what you use, bonds, stocks, whatever you build, gold, Bitcoin. It doesn't matter what the market is, what the asset class is. At one point in time, it is going to be in a big downtrend. It's going to wipe out a lot of your profits. It's going to act like it's never acted before.
Yeah.
The only thing that can solve that is having trend following rules.
Okay. Hey, okay. So can I ask you one last question, and then I'll let somebody else get up here. So in a typical, if you want to call it a black box or a rules, I'm assuming that they've kind of got layered in to those rules like a short, medium, long term, and that they're kind of managing, for lack of a better term, kind of like a layered strategy where, there's a portion that they're just almost sniping trends, and then they may be looking at more of like a weekly trend, and then some may be looking as long as like monthly trend. Is that fairly accurate, or do they all kind of stick to one time frame?
I mean, I don't really know for sure. People describe their systems. Some describe it that way. But I think there's a lot of people too that just do the weekly and the monthly and don't worry about the sniping so much.
Yeah. Terrific. Jerry, thank you so much, and I'll look forward to the next call. I'll let somebody else get up, and good luck out there, everyone.
I would say that it's very important. Of course, we talk about this all the time, but it's very important the ability to navigate the markets. And when we are buy and hold, when a person is buy and hold based, I think it reminds me like a train without stop. So it can be okay for many years, but if it's in an emergency situation, in crisis situation, we don't have any stops here. We don't have any ability to navigate, and we don't even think of this because we think that all will be okay. But the main philosophical aspect, one of the main philosophical aspects of a mindset of a business person is that future is really unpredictable. And this ability to navigate, ability to adapt, maybe is one of the main qualities. And even it was a study on a business site about business. I don't remember who did this study. It was about business in general, that this ability to adapt is maybe the main quality of a successful business.
Okay, this has been fun. Thanks for everybody for attending. Send me some DMs if you have questions, and hope everybody has a good weekend. And we'll come up with a different topic next week, unless we get Andrew, who wants to show up and discuss this even more. But I felt like we had a really good, exhaustive discussion about it. I was texting with Covell last night, and I encouraged him to maybe come on, and I could talk to him and ask him a few questions every now and then. Maybe we can start doing that. We'll turn it into kind of like a little podcast the first 15 minutes or so, where we can have a special guest sometimes. But he has COVID, so we got to wish him speedy recovery.